So looking at the charts real fast, yes, we have seen a market pullback. Yes, we've seen some profit taking in uncertain market environments. But overall, looking back, this is not bad price action whatsoever. I mean, it's healthy for the market to pull back like this, in my personal opinion. Like I mentioned, the market can't just go up for forever. Alrighty, what is going on, everybody? In today's video, we're going to do a fundamental overview discussing and talking about the current market conditions. Hopefully, in today's video, I really truly get you guys to see why it's so important to be paying attention to these things, as we are going to do a brief overview of some of the things that we were discussing in yesterday's Zoom call and on the fundamental breakdown, just showing you guys the level of accuracy again here that we are trading with, and that it is actually possible to call out these market moves in advance before they play out. So I feel like the vast majority of you guys that have been actually paying attention to detail and tapping into the Zoom calls, I really don't even need to break this stuff down to you guys. Most likely get it by now, but just so that way we can gather ourselves repetition and show up when nobody else does, let's talk through this. So as you guys can see, market's currently taking a dump. Yesterday, we discussed and talked about the possibility of a market correction under the conditions that were going to be set today surrounding Jerome Powell's commentary and the Fed positioning. Right now, as of time of recording, the market is down about $200 billion. So the numbers are going to differ a little bit from the time that I actually wrote this report out about 15 minutes ago for you guys. I'm going to also full circle and explain to you guys why I'm still optimistic in this report that I've written out for you guys, as long as we hold above key psychological levels in the total cryptocurrency market cap. So make sure that you guys stick around for the entirety of this breakdown. Okay. Let's get through this so you guys completely understand the market conditions and my perspective as we finish off the remainder of this week. So I will send this full report over to you guys here in just a second. I just have a couple of more screenshots to add for you all. Let's change the date on this one. This is the December 18th report. So today's market experienced significant profit taking following hawkish remarks from Federal Reserve Chair Jerome Powell, as highlighted in not only yesterday's Zoom call, but also in yesterday's fundamental breakdown. This scenario was most probable considering the conditions today that would be delivered if Jerome Powell was to give some hawkish remarks. Here is a screenshot from yesterday's report. If you come over here, December 17th, and we scroll right down here, you can see I mentioned to you guys, risk sentiment would dampen if we saw hawkish guidance from Jerome Powell delivering a tone that pushes back against the pace of rate cuts expected in 2025. Examples of this hawkish comments could weigh on risk sentiment. And here specifically, I just gave you guys some brief examples based off of my 9 years of experience of some hawkish comments. And look at what I said right here. Future policy decisions will remain data dependent. What did Jerome Powell say today? He literally said that word for word. We'll get into that in our report. He also mentioned that inflation is remaining persistent, sticky, and troublesome, and slightly elevated, which again, we'll also get into. So I gave you guys these specific scenarios. And then also in yesterday's fundamental Zoom call, at roughly around 19 minutes in the Zoom call yesterday, I dropped a link for you guys if you want to go back and watch it. We predicted this pullback to the T. I walked through scenarios with you guys, and I said over Asia and London session, we're most likely going to see a spike up to grab early sellers in the form of over-leveraged positions that are trying to sell before the news. And then after the news comes out and hawkish comments come flooding in from Jerome Powell, the market's most likely going to pull back towards December lows. So what I think is that the markets have already priced that in. What I think happens tomorrow is that they do deliver a rate cut, which usually tends to be bullish for risk assets. But then I think Jerome Powell is going to come out and dial back the pace of rate cut expectations in 2025. So initially, on the rate cut news, the market will most likely spike up to clear out some over-leveraged sellers that jump into the market early today. Everybody will be optimistic. Retail traders will get trapped in buy positions. And then Jerome Powell will come out with hawkish comments, and the market will correct the bullish rally that it has at the beginning of New York session. Something like this. Nothing too drastic. This is what I think price action will look like tomorrow. A nice spike up into highs and then a slight corrections. Word for word, that's what I said yesterday in a scenario walkthrough with you guys. And you can see today that that is unfolding literally to the T of a degree. So this is again why you guys should pay attention to this stuff, because nothing that we did yesterday was out of the ordinary or required rocket science understanding. It's just very simplistic supply and demand dynamics and understanding market sentiment. Okay. Now, like I said, I'm on the full circle and explain to you guys why I'm not overly pessimistic about this market pullback, and I'm still just going to consider this an opportunity to get in on discounted prices. Keep in mind, in previous calls, what else did I mention to you guys? That when we were rallying starting from pretty much the beginning of last week on Tuesday, when the market bottomed out at the December lows and started rallying, I said to you guys, now's not the time to be buying, right? Because the market was elevated, prices were up all across the board. I said to you guys how I dollar cost average in is I wait for opportunities like this. I specifically remember saying I don't dollar cost average in unless I see at least $100 billion wiped from the market on any specific day. So today, I will be updating you guys on dollar cost average levels once I take a look, just so that way you new members kind of understand how I operate. This is not a signals group. I don't just send dollar cost average positions out willy-nilly because I feel like it. I actually strategize and I try to build my portfolio when the markets are discounted, keeping dry powder on the sides when the market's elevated, and then deploying that dry powder when the markets are discounted like they are today. Not saying that prices couldn't go lower, but again, just keeping my average price buy-in for my DCA positions relatively low all across the board. All right, so later today when we get off the call and I come back to my computer to do my Asia session analysis, I'll make sure to send you guys out some good DCA positions that I'm looking at. I know that XLR is below 80 cents today, which is a steal in my opinion. I think also I was looking at Algo before below 40 cents, which is another steal considering its all-time high. So we'll get into those later today. All right, just to continue this breakdown. So, at the time of recording, at the time of writing, total cryptocurrency market cap, I got to change this number, is down over 200 billion, retreating from its high above the $3.7 trillion mark yesterday. Key developments driving market sentiment as of time of recording this video. Fed's hawkish revision to 2025 policy expectations. You guys remember in previous Zoom calls, we mentioned that the market tends to get ahead of itself, right? It lingers and holds on to the greed narrative. And the greed narrative was that the Federal Reserve was going to continue to cut rates. Well, the market has now dialed back those expectations slightly, and we're starting to see a more cautious, dialed back approach as we head into 2025, albeit I don't think it's the end of the world just yet. So stick around, okay? So the Federal Reserve's decision to revise its 2025 rate cut outlook in a more cautious direction, I highlighted that in bold. Anytime you see that word cautious or uncertainty, usually tends to result in a risk-off market environment. Remember, markets do not like caution and uncertainty. So those are two good key vocabulary words to kind of dictate moving forward. If you see those in fundamentals across the board, the sentiment is usually intraday risk-off. This cautious direction has spurred a rally in the US dollar. Futures markets are now reflecting a 57% probability of only 1 to 2 rate cuts in 2025, down from earlier expectations of a more aggressive easing cycle as we saw back in 2024. Powell's remarks reinforced a cautious approach, citing stronger economic growth, which is why the dollar is significantly higher against its major peers today, like the yen, the Great British Pound, so on and so forth. Lower unemployment and persistent inflation as factors limiting the pace of rate cuts. Here are some of Powell's key comments. We are significantly closer to neutral, still restrictive. As long as the labor market and economy are solid, we can be cautious as we consider further cuts. The slower pace of cuts reflects expectations of higher inflation this year and next. That is a hawkish comment right there. Risks and uncertainty around inflation remain elevated. That is also an extremely hawkish comment right there. Powell emphasized that the Fed would remain data dependent, as I said yesterday in the fundamental call, as you guys can see, highlighting that for you guys before the retail herd gets that info.
In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course.
And responding to economic conditions as they evolve moving forward into 2025. So that's the same thing that we are going to do here, which is why I'm going to explain to you guys that I'm not overly pessimistic yet. So let's just understand why the terminology or, key vocabulary or sentiment, hawkishness, leads to a risk off market sentiment. So I wrote down for you guys, a hawkish tone combined with uncertainty tends to create a risk-off mood as investors seek safety in assets like the US dollar or treasuries. This intraday risk aversion is driven by multiple different factors. Fear of higher for longer rates, reducing attractiveness of risk assets, market makers repositioning themselves in safer positions. Like I mentioned, markets dialing back their previous bets on rate cuts. Uncertainty over inflation, those key words, elevated inflation, uncertainty, those are all words that tend to weigh on risk sentiment. Lingering concerns about price stability also add pressure to speculative markets. And then all of this tends to lead to profit-taking behavior. After strong rallies like we've seen in November and December so far, hawkish surprises often trigger broad sell-offs as traders lock in gains due to the market uncertainty. So real fast, let's kind of switch. That's the primary reason why we're seeing markets down across the board today. You guys know that we still have the Bank of Japan monetary policy announcement and statements later today, heading into Asia session. And then tomorrow, relatively speaking, early this morning here in the United States, we have the Bank of England monetary policy announcement as well. So we'll be paying attention to that. We'll get into that in just 1 second. But there are some reasons to be optimistic despite this market pullback. While the market is temporarily adjusting its expectations, I noticed some comments from Powell that provide some silver linings. And there's three that I want you guys to primarily focus on. So the first one, he said, policy is well positioned to deal with risks. Keep in mind, I just mentioned to you guys that the markets don't like uncertainty. So if they are well positioned to deal with risks, if they see any risks, then, he's pretty much confirming to some degree that they have means to deal with those risks. So that then provides some form of market certainty. The second thing he said is that the Fed can ease quickly if inflation drops or labor markets weaken. So moving forward into 2025, what do we need to be paying attention to? Obviously, of course, if we want to see a sustained risk on market sentiment, we need to see lower inflation and cooling in the labor market continue heading into 2025 to see a sustained rate cut trajectory. Then he also said inflation story is broadly on track. Now, I really like that because, again, the market right now is dialing back those rate cut bets. However, Jerome Powell said that he still thinks that the inflationary story is still broadly on track.
We keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%.
So maybe right now, in the moment, the market is reacting to those comments negatively, dialing back the expectation. If you're just looking at the price action, remember I mentioned to you guys, right, that here, all these market rallies were when we were pricing in, seeing the market makers start to price in rate cuts, okay? And now the market has dialed that back. Maybe after the market kind of dials those expectations back a little bit and we start to fall into these discounted prices, the market settles and the rally continues because, again, what did Jerome Powell just say? That the inflationary story is still broadly on track. Maybe heading into 2025, we still see moderate inflationary figures or inflation even slightly ticking down from previous readings, still being well under control. Okay, so that's why I'm not too pessimistic right now, and I'm still just being data dependent. Powell also reiterated multiple times that further rate cuts in 2025 would depend on data. This means positive economic indicators such as declining inflation or stronger employment figures could reignite optimism for more accommodative Fed policy in the coming year. Now, here it says stronger employment figures and declining inflation. What does that prompt, or what does that suggest that the Fed is going to achieve if we see stronger employment figures coupled with lower inflationary figures? It's a two-word vocabulary term that I tell you guys usually tends to boost risk asset optimism. Can anybody tell me what that is?
Soft landing.
Beautiful. Whoever said that, pat yourself on the back. Easy, broadly, right? If you see that terminology and you see, hey, look, the Fed's probably going to achieve a soft landing in any of the fundamental reports from Bloomberg, from Reuters, from whatever lead mainstream article news thing, it usually tends to boost risk asset optimism because that tends to lead to lower or a cut in interest rates. Okay. So here you can see I wrote that for you guys. Just keep that in mind heading into 2025. If we can see indicators such as declining inflation and stronger employment figures in that terminology, the Fed achieving a soft landing, then again, risk on optimism could still be on the table. All right. And here you guys can see also something else that we've been talking about in the CYPRX private community is these tariffs and how they're going to affect inflation in 2025, the ones that President Trump could impose when he becomes inaugurated into office. Okay. And so right here, something else that I noticed that could still kind of keep a bullish sentiment and why I'm not panic selling right now is because Jerome Powell said here that it's premature to make any conclusions on the impact of tariffs, and that he does not know what countries and what size and how long these effects could have, right? And so I was just doing a little bit more research on this, and it actually seems that analysts technically agree. So here I just added it to fundamental reports that I read to kind of give me a better understanding of the situation. And so right here in red, you can see, we'll click this, open the first article, and we'll read this, and it says, on top of that, President-elect Donald Trump has proposed a range of tax cuts and Social Security benefits, tipped income and overtime income, as well as the scaling back of regulations. Collectively, these moves could stimulate growth. At the same time, Trump has also threatened to impose a variety of tariffs and seek mass deportations of migrants, which could accelerate inflation. Chair Jerome Powell and the other Fed officials have said they won't be able to assess how Trump's policies might affect the economy or their own rate decision until more details are made available. And it's become clear how likely it is that the president-elect's proposals will actually be enacted. Until then, the outcome of the presidential election has most likely heightened the uncertainty surrounding the economy. Okay, so that's why the markets are a little bit unsure right now. However, look at what this analyst here said. So it says one equity strategist says that the US President-elect Donald Trump's threat to impose sweeping tariffs on goods from Canada on his first day in office next month would immediately hurt American consumers and is unlikely to happen without major carve-outs. The way I think of Trump is that he should be taken seriously, but not literally, said, and this is the gentleman's name right here, Ian, I don't want to butcher his last name, equity strategist at CIBC Capital Markets told BNN Bloomberg in a Wednesday interview, historically, he's quite extreme and uses a lot of rhetoric. But at the end of the day, we need to think it through in terms of what he's trying to achieve. And let's go back to the first principle, MAGA, or Make America Great Again. He said Trump's Make America Great Again slogan would be tested if Trump followed through on his threat to impose a 25% tariff on Mexican and Canadian goods entering the U.S. unless both countries address the incoming president border concerns. The concept of a 25% tax tariff across the board on everything from fossil fuels to auto parts to a variety of things like that, I think would almost immediately impact the U.S. consumer negatively, he said. So it's unlikely, according to him, that Trump is going to actually follow through with this. So I think it's unlikely. But let's be absolutely clear. We are predicting what a relatively mercurial incoming US president will do. But our view is for sure that the impact will be less than the market currently expects. So I highlighted that right there because, again, right now, what are we here talking about in the CYPRX community? What did I show you guys? Individual participants like Signum or BlackRock are all talking about. Also, UBS in their reports that I share with you guys in the CYPRX Discord are all talking about the possible Trump tariffs. And so maybe this guy is right. Maybe the market's kind of like overly anticipating that inflation is going to significantly increase if Trump imposes these tariffs, if he even does. And that's again what's kind of fueling this fire for, an uncertain market outlook into 2025. If he does not impose the tariffs, and we don't see higher inflation, and we see lower inflation figures and economic stability in the US, and the Fed can achieve a soft landing, then we have to trade with that moving tide. And that moving tide would most likely be a continued risk on optimism market mood. Okay. So again, we just need to be data dependent. I wanted to bring that to everybody's attention as well, because I did notice that Jerome Powell, like I said, he mentioned it's too early. He said it's too premature to make any conclusions on the impact of tariffs. So if Jerome Powell isn't worried about the tariffs, I'm not going to necessarily say we should match his beliefs. Obviously, of course, we just need to remain data dependent, but still, I have a firm belief that him saying that, coupled with an actual strategist mentioning that the market may be overreacting to that, is definitely something to be mindful of. Okay. I'm going to always, of course, factor in everything here and not marry a bias. I've said that I think that that is one of the most detrimental factors that could negatively affect risk assets in the coming months. But if it doesn't unfold, then there's nothing that we need to worry about, right? So with that being said, let's just take a pause real quick. Let's see, where did I mention the PA? Let's go down here. So I said, despite today's pullback, the crypto market remains in a bullish structure on the higher time frame, trading above the key $3 trillion level for now. Uncertainty will likely linger until more clarity emerges from the Bank of Japan and the Bank of England and incoming U.S. economic data to close off the week before the holidays. So, looking at the charts real fast, yes, we have seen a market pullback. Yes, we've seen some profit taking in uncertain market environments. But overall, looking back, this is not bad price action whatsoever. I mean, it's healthy for the market to pull back like this, in my personal opinion. Like I mentioned, the market can't just go up for forever. And so, for market makers to reposition themselves into discounted positions, we need to see some profit taking and reallocation of capital. As of right now, just because we're seeing a slightly risk off market environment and some profit taking unfold, we are not seeing any bullish break of structure. So yes, we have the fundamentals. Remember, I talked to you guys about layering these things. We have the fundamentals to be slightly pessimistic in the short term and kind of be like, okay, we definitely need to be paying attention to metrics here. But we haven't really seen any massive liquidations of over leveraged buy positions. For example, pretty much everybody that's in over leveraged buy positions underneath of these two previous higher lows are still operating in the market, right? So until those over leveraged buy positions get attacked and the market sentiment dampens, pushing price beneath those levels, and we start to see higher time frame, i.e., 8 hour and above daily closes below, I'm going to remain optimistic that to some degree, depending on how the Bank of Japan monetary policy announcement unfolds over the next 24 to 48 hours, I'm going to remain optimistic that we're going to see some type of reaccumulation and a market continuation, whether that's a deeper retracement down in a 2.9 to $3 trillion in the market bounce, or whether that's a small or slight retracement from where we currently stand now to possibly even coming back down into 3 trillion and seeing a market bounce from there. But until we see anything outside of those types of metrics, I have to remain optimistic, because for me, as a technical analyst and a fundamental analyst, we're seeing some slightly downbeat fundamentals, right? Way on risk sentiment, but we're not seeing technical confirms with that. So I have to just point that out to you guys. Okay. Now, if we do break these mid-November lows and we do see worsening market conditions continuing to dampen market sentiment, at that point in time, if we can break and close below on the 8 hour and above $2.9 trillion, and we can see worsening market conditions, then I will start to consider taking profit on positions like soy, like I mentioned to you guys. We were getting in at 50 cents, Arrow, 55 cents, so on and so forth. All those positions that we were securing back in like August, September are still going to be trading relatively higher than they were back then. And so that'll give me plenty of time to secure some profits without panic selling from where we currently stand now. Still being able to secure some good profits from those positions and those entries. All right. Again, just taking a more strategic approach and not basing my decisions in these markets off of emotions.